the Nasdaq. They announced that they are working on 24/5 trading, 24-hour trading, Thomas. And even though we have like some of this exists, it's on the individual broker and it's on an individual market maker. Like it exists in a weird way that I never thought made sense. I thought if this was going to exist, it should exist at the exchange level. And it looks like the Nasdaq is going to introduce 24/5 trading so that the retail world is going to move closer towards a world where we can bet on stocks. And who knows, maybe at some point options at all times of the day. And I never really got to have this conversation with you a few weeks ago when this dropped. You've always predicted that we would be moving towards this world. One, how do you feel that your prediction is starting to come true? And then how rapidly do you think this idea of 24/5 at the exchange level for equities changes into us trading, having more than 6.5 hours to trade options in the future?
Well, first of all, I'm glad you brought up this topic because I think this topic is bigger than you're making it out to be, at least at this point. And I'll tell you why. Because it's not just the Nasdaq. The New York Stock Exchange is going to 24 hours. The Nasdaq's going to 24 hours. The CBOE is going to 24 hours with stocks, not options yet. There's not enough there's not enough business or market making to do options yet. But the point is, the CME's been 24 hours, 24/5 now for a decade. Crypto's 24/5, 24/7. I'm sorry, crypto.
24/7. Yeah.
There's no reason that equities shouldn't be 24/5 at least, or 24/7, or completely tokenized, or everything else. And what's in the process of happening right now is you're beginning to see what our kids will see in the future. Like when your kids grow up and they trade, they're going to be able to trade 24 hours a day, 7 days a week. And you're going to go, I remember when the market was only open for 6.5 hours a day, which seems ridiculous.
Yeah.
That McDonald's is open longer than the stock market.
Yeah.
And so I think what's happening is the listed financial markets are facing, they're about to enter into a transition period where they're going to face the reality of global markets, which I think is a really good thing. And I also think it is going to be the precursor for everything in finance to go to 24 hours, whether it's blockchain related, because that seems to be easier, or whether it's crypto related or digital asset related, or whether it's listed exchange related. Victor, we're going to 24-hour trading. We're going to 24-hour banking. We're going to 24-hour basically everything with respect to
7 days a week too, probably.
7 days a week, 24 hours a day.
Yeah.
Because
we have the technology and we can do it.
That's right. Because we can.
Right.
And that makes the world more efficient. That makes everything cheaper. That makes the consumer happier. And
thanks, Trump. Sorry, Vic. I just had to just do that. I mean,
hey, don't say sorry to me, bro. I've got no issues with it.
I did thanks Joe Biden for 4 years. I had every once in a while I got to thanks.
The point here, Vic, is that 24-hour trading stocks is a really good thing, but not just because Victor Jones is going to wake up at or at 11 o'clock at night is going to say, "Oh my God, I need to buy 100 shares of IBM." That's not what's happening. The reason it's a good thing is because Victor Jones.
I've never said that in my life.
Well, maybe you should, Victor. Maybe you should. All right.
All right. You woke up in the middle of the night and you go,
I've said
what?
Palantir. I need to buy.
I got to have some Palantir.
I gotta have some
mining.
Palantir. There you go.
Freeport McMoran.
Yeah, I got to have some Palantir and Freeport McMoran. I can't sleep.
Can't stand it.
Come back to bed, Victor. No, I got to buy some Palantir. Okay, that's not.
I put the heels on. No, Palantir.
Okay. So, what's important is that this is going to open the door to everything else that we want to see happen in the world of finance. And this is where we're getting our foot in the door. This opens the door. This is the crack that we've been waiting for. This goes to 24-hour banking. This goes to 24-hour loan. This goes to everything going around the clock, all being, whether it leads to, like I said, whether it leads to more peer-to-peer interactions, whether it becomes all blockchain-based, whether it becomes all tokenized, or whether it's just all done centrally cleared on listed exchanges. It doesn't matter. This is the first step. And if you miss this, like if you don't get it, if you don't understand the importance of it or you miss it, you will be left behind.
I couldn't agree with you more. I think you and Tony have had this conversations for years, and we're getting close. And I think at the point where Larry Fink the other day advocated for the SEC to effectively get on board with moving bonds and stocks onto blockchain. I mean, this is an eventuality, I think. But I guess I'm curious, what matters more? Does it matter more that we are going to be adopting new technology like blockchain, potentially expanding hours? Or does it matter more that somehow capital markets are able to attract IPOs in early stage private companies? Which one of those two things do you think matters more to the retail participant like me? Because on one end, you have private companies that are not going public until much later stages. And then on the other end, you have all this increased technology and ability to clear in a less risky way, which removes costs and time and friction from transactions. What do you think matters more to the individual retail investor? Is it the technology advancing, but without new issues? Or do you think new issues are equally important, and what needs to happen to bring more new issues at early stage companies to the market?
Well, it's a really good question, but I think that part of the answer is that one of the reasons that it's more difficult to take your company public is not just because companies don't want to go public. It's also because you have companies now at the top of the food chain that are like, let's say $3 billion or $4 billion, trillion dollars. If you have a $3 trillion company, okay, it is very hard to generate excitement for a $2 billion company. And I know that's going to sound like almost elitist, but it's not. Used to be a big company would be like 10 billion, 20 billion, 50 billion, 100 billion was a big company. 500 billion was a massive company, right? Just 20 years ago. Now you've got these companies that are 3 trillion. So now people look at a $100 billion company as if it's a tiny company.
Yeah.
So a $2 billion company is like, what do I want with you? That's like pocket change.
Right.
And so the challenge is there's only so many of these massive companies that are going public at, 50 billion or 100 billion. There's not that many companies like that. And so what looks like less IPOs is it's hard to generate interest now. 20 years ago, you want to take a company public at $1 billion, it's freaking massive.
You were moving a ship.
Yeah, you were moving a ship. Now $1 billion, they laugh at you.
Tiny fishing boat.
You can't even get Goldman Sachs to pick up the phone.
Right.
So the world's changed. And that, I think, is one of the challenges. And that's one of the reasons that companies don't go public as often, because they just don't have the size. And it's also they can't attract the investment banking world or the institutional world as investors. That was kind of one of the things that led to all those kind of SPAC deals that kind of failed, because there wasn't the same level of due diligence and everything else that went into that whole period in time. So I think it's a combination of both things that you said. I think it's a combination of, hey, the markets have shifted, and and then there's also culturally we've shifted a little bit into bigger deals. Let's put it that way.
Do you think these markets carp each other? I've never asked you this. You've always said, both of you guys have always said, you advocated a world where you could trade everything. At some point, you and TP, that was sort of what you were trying to do.
We've been on that train for 20 years. The whole idea that every person can trade everything has been our thing from day one. And now everybody's catching up with it. Like, last night, Kraken making a deal for a broker dealer. I mean, it's just like the whole world's finally figuring out what we've been saying literally for 20 years.
But this is my point. So, Chris and I were having a conversation the other day, and we can talk about the public markets and their bets on whether or not Mark Carney is going to win the future election in Canada, and sort of So I wonder, like in a world where you sort of we're almost there, where you can bet everything, and not only that, but you have these, these different tokens where you can trade effectively the excess liquidity in the marketplace as well. Do you think this has been good for equities? Like, is it a good thing that I can choose whether or not to trade Apple or take my money and go to the betting markets? Is it a good thing that I can choose whether or not to deploy capital to some diversified quote unquote ETF or take my money over to or to cryptocurrency? Is this a good thing in your opinion for equity market and market structure? The competition.
Yes, 100% it's a good thing, but let's not confuse betting markets with real financial markets. Betting markets and event-based markets are still a joke size-wise.
I mean, it's 10%.
The VIG on, if you trade an event-based contract, okay, here's how crazy this is. If you do 100, look at S&Ps.
Up 3.
Up $4, Nasdaq up 20. What a rally. VIG, I'm going to show you the difference, and this is why event-based stuff sucks. I mean, when I say sucks, it's good to have and it expands, but it's
not as efficient as it should be.
But
it could be.
It's not about efficiency. It's why it won't. It's why it never will be. It's why it never will cannibalize the listed marketplace. And I'll explain in one easy lesson here. You buy $100,000 worth of spiders. Okay, let's just say you buy 200 shares of spiders. It's $112,000. 200 shares. The bid-ask differential is $2, all right? $2. You go bet on, who'd you say, Carney?
Yeah.
You go bet on Mark Carney winning winning the parliamentary vote in Canada. Okay? Now remember, $112,000, you have $2 wide spread. Now you take the same exact bet and you go to an event-based exchange like Kalshi or anybody else. You bet $200 on Mark Carney to win. $200. You have to put up in fees $2. So on the one hand, I just bet $112,000 on SPY. $112,000. And the other hand, I bet $200. The fees are the same. This is why event-based betting is always going to be a freaking joke, because the fees are so high as a percentage of what you're doing that nobody will ever take that serious. It's never going to be a serious investment until the fee to do that is $1. I'm sorry, is a penny.
Penny, 1.
And the chances of it going from $1 to a penny?
0.
So this is why DraftKings, this is why FanDuel, this is why the event-based markets like Predictit, Kalshi, and everything else, or whoever else offers it, it's always going to be just a secondary joke of a marketplace. It's going to be cool to have. It's a nice to have. Because if Tony wants to bet on the NCAAs and he wants to go to a listed marketplace, or he wants to bet on who's going to win the presidential election, yeah, okay, I'll throw down $100 or $1,000, whatever it is. But if you want to bet $100,000 that the S&Ps are going to go higher, and put up, you're going to, there's nobody's going to do that. Nobody's going to say, nobody's going to put up $100,000 to bet on the election and put up 10,000 in fees.
Yeah, no, never going to happen.
They're not going to happen.
Vic, he sounds so smart when he speaks with you. Maybe I should start doing the trading for him, and then we can have a successful little business here. What do you think, Vic?